Morning, everyone. We are almost going live in the next minute or so. We're just waiting for a few other people to join us. Okay, so Wendy, everyone, thank you, panel, everyone being on the call. I see there's still a few people joining us, but I think we should get cracking. Otherwise, we're going to run out of time because we have a tightly packed schedule. My name is Tiaan de Wit. Those of you who don't know me, I'm the Executive Head of NMG Financial Planning. And this is the first of a quarterly webinar series that we're going to run on a quarterly basis, where we're just going to give some updates on what's happening in the markets when it comes to investments. So it will be focused really around investments. And part of the process will also be to just upskill all of our members and our clients in the process so that they can also understand when we talk about some investment jargon, what it entails. So on the panel discussion today, I have JB Smith from Sequoia, MD of Sequoia Capital, one of our partners, and then Chris Harmse, Professor Chris Harmse, or Dr. Chris Harmse, that one of the chief economists of Sequoia Capital, and Hugo Fourie, part of Sanlam Private Wealth, one of the fund managers that we utilize on specifically private personal share portfolios, etc., etc. So I'm going to hand over to JB. JB is going to handle the introduction of everything, and then then we'll do a bit of a Q&A. Just on a point of order, you'll see there is a chat in the chat functionality. Any questions that you want to address or ask during the sessions, you're more than welcome to ask them, and hopefully we'll be able to get through all those questions as well. So feel free to use the chat functionality at the bottom of your screen. Okay, JB, over to you.
Hello, Tiaan. Good morning to everybody. It's always nice to interact with clients. I think being a fund manager, the one thing that you always forget is that you're looking after individuals' assets, and you tend to spend less time with clients and more getting better down into data and spreadsheets and all of that. So it's always good to be able to talk to clients. So I thought best to do a short introduction and context on last year before I hand over to Dr. Harmse, who's going to talk obviously about load shedding and the impact of that. I think it's a quite relevant topic since the beginning of this year. It's strange how we get used to this. And a couple of years ago, we were all up in arms when we had stage 2 load shedding. Now the norm seems to be stage 5 and 6. So obviously there will be a direct impact on our economy, and also I think the indirect impact is also quite important to understand. So before Dr. Adams kicks off with that, allow me just a couple of minutes just to give a bit of context of what happened last year. And because we tend to, the strange thing is that news media and news flow would always try to persuade investors to run offshore, invest offshore. And in a year like last year, strangely enough, your local investments actually did better. And we tend to forget that. So I want to just spend a couple of times just giving context of what happened last year. And I'm gonna do that by using some visuals. It's nice to talk to visuals. So what I'm showing here is a chart of the returns on US stocks on the bottom, and on the left hand side is the returns of US bonds. Now this is data at the end of last year, but it stretches from 1871. So it's a very long data set. And what you're looking at is the higher you are to the upper left, the higher the US bonds did in that prevailing year. The more you are to the upper right corner, to the right-hand side of the chart, the better stocks are. So if you were in the upper right-hand corner, then that year US bonds and US stocks would have done tremendously well. But the interesting fact is that the circle at the bottom, the red circle, is where we ended last year. Essentially last year, in the context of US stock markets. Now, why I use the US stock market is, remember, the US stock market represents about 65% of global financial markets. The US stock market had the worst year since 1871. So bonds were down by 15%. No, this is dollar terms. So if you want to translate that to rand terms, just add 7% to that. So the rand depreciated by about 7% last year. And US stocks lost about 20% in dollar terms last year. So it was an atrocious year for US stocks. And I think what makes it even more worse is that US bonds followed suit. Normally, if you look at the financial crisis of 2008, stocks lost even more. So they lost about 40%. I know the exact number is 36% in 2008. But at least if you were invested in bonds, which is a safe haven asset, you essentially would be cushioned against the massive fall. That's why you see 2008 sitting nice and pretty there. And last year was a phenomena that hasn't been seen, well, since 1871. So it was a really, really difficult year. Now, how does that play out in the South African market context? Now, it's quite a really busy chart, but focus on the blue bars and the red dots. So this is from 1980, so it's about 42 years of data. And you can see all the different returns for various years that the JSE had at the end of that year. But the red dot shows you the drawdown. At some point in that year, the market was down extensively. And if you look at last year, at some point in time, our local market was down 16%. Now, just keep in mind, this chart doesn't include dividends. So at some point in time, the market was down 16%. And it ended the year basically flat if you don't include dividends. If you include dividends, then it ended up about 3.5%. It actually illustrates the importance of dividends, that compounding effect. So our market, although it had a difficult year compared to its history. Now, if I talk about history, you can look at that blue dotted line. That's where the history lies. So it was difficult here in our market, but actually our market did much better than global markets. Now, the next question I always get asked is that, but you guys do forecasting. You should have seen what happened. Or should have seen this happening. And I want to illustrate the effects of forecasting. And what I'm showing here is the forecasting that a couple of global investment houses. Now, these are superpowers in terms of financial markets. What their forecasts were for the S&P 500 last year. So they did these forecasts at the beginning of 2022. And they said at the end of 2022, this is where they see the level of the S&P 500, where it's going to end up. I mean, these names are big. Goldman Sachs, Credit Suisse, Deutsche Bank, Bank of America. I mean, it's massive names. And these are their forecasts for the year. Now, the question is, where did the market, S&P 500, end the year? So, and there it is. It ended at 3,800. So none of these guys essentially got forecasted correctly where the market's going to end, and the margin is quite big. Someone like Morgan Stanley was close enough, but someone like Deutsche Bank, well, he was way off. So the reason why I want to show this is that it's extremely difficult to forecast what's going to happen in the markets. And now you ask yourself, but if you can't forecast, then how do you approach investing? And investing essentially is about staying in the market. And I'm going to illustrate again this quite quickly. And this is a typical chart that you most probably have seen quite a lot. It's again 40-year data until the end of 2020, March 2020. And it shows you your return on your investment that you invested $10,000 in the S&P 500 index. So then you would have made almost $700,000. Had you missed the 5 best days, just the 5 best days, almost 40 years, then essentially almost half your investment. You've missed the 10 best days, even worse. If you missed the best 50 days out of the last 40 years, now think about it. It's 50 days out of 14,000 days. More than 14,000 days, your investment would be about 48,000 rand. That's a massive missed growth potential that you would have left on the table or would have thrown off the table by missing those days. So essentially what this implies is that sometimes it's just better to stay in the market and stay invested. But I want to illustrate this point rather by looking at the local market. This is something that we can relate to. This is a data set we did some time ago. So it's only until the end of 2013, but the principle will still apply. So it's 10 years. And what I show here is the return of the JC All Share Index over that 10 years. But let's say this should exercise, and you say in these 10 calendar years, let's say we can miss the worst month. We've got foresight, and that's why I put up that crystal ball. So we've got foresight, and we're going to miss the best, the worst month in each of those 10 calendar years. What would have happened? That's the outcome. I mean, you would have done 3 times better than the average market. So you would have done awesome. But it's quite difficult to get your timing right. And let's say you got your timing all wrong. And instead of missing the 10 worst days, you missed the 10 best calendar months in the last 10 years. So let's say you missed the 10. You missed the best month in the last 10 years. What would have been the outcome? That's a purple line. So had you missed that, you'd have done half what the JSE did. Now, just for completeness sake, let's say you missed the best and the worst month. Then you pretty much would have ended on the same place as the JSE, just without so much volatility. And obviously, the big one is cash. I mean, I would have just stayed in cash. Oh, that's the impact of cash. If you missed that the best month in the last 10 years, in each year, you would have still done better than cash. But here's the important part of this whole chart. I've shown you a lot now, but it's not the important part. Here's the important part. These are those worst and best months in each of those years. The important thing to notice is how close they are to one another. They are extremely close to one another. The best, a worst month is the probability of a good month following a worst month is quite good. And the thing is, as an investor, you will never get this timing right. You will never exit the market before it goes down. You'll never enter the market before it goes up. So that's why it's important. Timing the market is important. Now, we're going to talk about a lot of information today. Dr. Adams is going to talk about the impact on the economy and inflation, and Nico is going to talk about how do you position your portfolio for 2023. But the important part is none of this is going to be it's going to focus on where you should enter and exit the market. It's always going to be premised on the fact that stay invested, irrespective of what's happening. Yes, you should have a proper advisor that's advising you. You should have a proper portfolio manager that's looking after your portfolio, and when necessary, make tactical changes. But the important part of all of this is to stay invested in the market. With that, I'm gonna hand over to Dr. Adams, who's going to take us into the effects of load shedding. I think we are sitting at the back of also a current Eskom CEO who's retiring, or not retiring, who's stepping away soon, and also the Chief Operating Officer of Eskom, Jan Oberholzer, who's also going to retire this year. So big changes at Eskom and on the management. So Dr. Adams, over to you.
Thank you, JB. Thank you, everyone. I assume you can hear me. Well, load shedding in South African economy, we may put in brackets, the ultimate black swan. Because analysis now tells us this unpredicted appearance in the South African economy may be far more severe than we think. Just to give you a background, these black swans, of course, appear from time to time. We go back into history. Me studying economics in the middle 70s, then everyone talked about the US leaving the gold standard in the late 60s, and then we had the two enormous oil shocks in the beginning of the 70s, pushing world economy into recession so that the US couldn't uphold its deficit with the rest of the world, and for that went to a floating exchange rate. So it turned the markets totally around. We had an Asian financial crisis in the 80s, and then we have, at the beginning of the millennium, the IT bubble. So those are all black swans, but a big one, of course, we know that started basically in 2007, beginning of 2007, and listen to my words, I do not call it the subprime crisis. The subprime crisis was only a reaction to the massive increase in oil prices again during the years 2006 to 2008, going from $18 to $140 within a year or so, pushing up US inflation. And US interest had to be increased 17 times, pushing house market in a bubble. So these shocks do appear, but the problem that we have now here is that Cinderella's black swan in movement is now coming over the last 10 years already. Now, if you look at the next slide, the big problem with load shedding at this stage is politicians that think we're not in a crisis, whereas the economy is on the brink of a possible collapse. Now, let's listen to what the CEO Reuters said in this video on what he sees as the most important reasons why we sit in a situation like we are experiencing, especially over the last 6 months. So this
We've known about load shedding since 1998, when the Energy White Paper recorded that Eskom was asking for new capacity to be added on an urgent basis. In its wisdom, government at the time disagreed and said that it had other priorities and that the money should be allocated to other needs. We then had no option but to create virtual capacity. That is, by deferring maintenance, by postponing midlife refurbishments, and by running our plants harder than the international norm would indicate. This happened from 2002 onwards. So there was a deliberate decision to neglect maintenance in order to prevent load shedding. Now, at the time, President Thabo Mbeki acknowledged that government was wrong and Eskom was right. And in 2007, Medupi, Kusile, and Ngula were started. I think it's common cause that these projects were poorly planned. They were executed by Eskom as the project manager without adequate project management assistance, and as a consequence of corruption that interfered in the award of the boiler contract, in particular, to Hitachi. Design defects were incorporated into the design of the boilers for both Medupi and Kusile. Now, this is highly relevant, Honourable Chair, when it comes to considering load shedding as we're experiencing it today, because this has a direct causal effect on the incident at Kusile, which rendered units 1, 2, and 3 inoperable. In 2008, load shedding started for the first time. So this is not a new phenomenon. So the political decision was made and it was executed, but deferring maintenance is like borrowing from the future. So this is the situation that we are in today.
Well, having that as a background, it's no wonder if you look at budget since about 2013 onwards up to last year, the massive amounts that government provided as a bailout for Eskom over the last 10 years. In fact, the last 4 years alone, 255 billion. So that is how they planned it. They just put a bandage on it, plaster every year, and try to cover it up. But now what we have now to do is analyze what's the possible effects of this reality on the South African economy. Now, as a macroeconomic analysis, we always teach our students, this is macroeconomics 10A, that if you want to measure the performance of any economy, you basically look at 4 main outcomes. First one, of course, is growth. The second one, of course, is inflation. The third one, of course, is employment. And then your last one, especially South Africa, that's an open economy, your relationship with the rest of the world, which is as a proxy, we can use the exchange rate. Now, looking at those, if you look at the first outcome in the next slide, sorry, before we come there, let's have a look at this as Eskom. You can see how, you know, it had a structural change on the various aggregates that Eskom presented in the economy. Since 2008, and this is what Mr. Reuters said, from 2007, the problem started. So if you look at 2008, a revenue earned profit of Eskom. It's well known that at the end of the 1990s, Eskom was awarded one of the best utility companies in the world. Now, if you look at that installed capacity in 2008 to 2022, remember by 2008, South Africans, and I've checked it yesterday, we had a population of about 32 million people. Today, it almost doubled. Right, it is in the vicinity of about 56 million. So the installed capacity was almost the same than 10 years, more than 10, 12, 14 years later. The electricity that they sold over that time was even about 30% more. And that led to their profit. Look at the staff that's employed. So this was a employment agency, right? It increased tremendously, and of course, then your employee cost will go up tremendously. And you know, if you try to keep up with higher labor cost, the only thing that you can do is increase your selling price. Now, for a monopolist, that's normally an easy thing, right? We teach also economic students that the monopolist, you know, he can change his price and keep up into profits, or at least cover his average cost, including his employee cost. So the selling price for electricity went up through the roof, right? From 19.45 a unit to 127.9. So of course, your cost per employee also have increased tremendously. The electricity sold by employee unfortunately came down, and the energy available factor is also lower. So lower energy available, higher cost, profits, and then of course profits going down the drain, and a 400 billion rand debt. In any private business environment, Eskom would have been liquidated long ago. Now, having said that, the enormity that it will have on the impact on economic growth, this is the danger of load shedding. Now, over the last month or two, various forecasts came to the table of various institutions looking at what may be the effect. The well-known Bloomberg monthly survey tells us that only due to load shedding, we have a 45% chance of moving in a recession. And at the end of last year, it was only 25%. I think since about Christmas or the beginning of December, when we had more days level 5 and 6 than not, these projections start now to come to the fore. The IMF projects South Africa's economy 1.1% lower for 2022 at 1.2%. So at the beginning of last year, the Reserve Bank, the IMF, the government projected an economic growth rate for 2020 of about 2.3%. The IMF, as well as the Bloomberg survey, now echoes the IMF, say that the GDP growth will be not more than 1% in 2022, and they expect this year to be as low as 0.5%. That is lower than even the year before the COVID virus. Now, we had an economic growth rate of 0.6. Now, if you look at the Reserve Bank, in its latest Monetary Policy Committee report last Thursday, said that for 2023, and as a result of this extensive load shedding, the bank now forecasts GDP growth of only 0.3%. In other words, given the scale of load shedding, the bank now estimates that it deducts as much as 2 percentage points from growth in 2023, compared to the previous estimates of 0.6 percentage point. Now, I just looked this morning for my another report for SACOA on the monthly economic report on the world as well as South Africa. The IMF now also scaled down the world economic growth on about 2.8%. So we are one of the few countries that they predict also an economic growth rate of less than 0.5%. The second impact on any economy of such events are, of course, the impact on inflation. Now, if you look at the weight that electricity plays in the basket as part of the so-called household operation, that in fact is the biggest weight in the basket of about 25%. If you look at the expected increase of 18.5% in April, if we're going to see that, the April CPI is to increase by 0.6%. The latest rumor in the market, and we'll see that in 3 weeks from now on, is that the government is not going to allow that 18.5% and is looking at an increase for the households of more or less equal to the inflation rate of 7% and will subsidize it from loan financing or maybe higher taxes in its budget, pushing up, of course, South Africa's debt to levels around 80%. If you're going to add also the expectation that the fuel levy will increase substantially to finance the e-toll system in Gauteng. So we're in for a rough ride in the next few weeks. But let's have a look at the indirect effects. That inflation is about to increase with a whole 1% during April and May. If you look at all the downstream input-output effects of that tremendous increase in electricity prices. Now, the rand, of course, will stay under pressure. We'll have a picture on the rand. Unless we see a USD weakness, but looking at the more hawkish approach of the Fed yesterday, it seems though that the inflation trajectory in the US also seems to stay high, and that the Fed, given the fact that unemployment rate stays at 3.6%, is not finished with the interest rate cycle. So we may see US dollar remains very strong. Then, of course, the repo rate definitely will be higher for longer, and bond rates also will stay evaluated. Now, if you look at that picture, the Reserve Bank already see that the food inflation is quite higher, peaking at the beginning of 2023 at just over 12%, and is going to be a higher than 10% for a longer period, and see still the average of 7% for this year in 2023. Now, if you look at unemployment, that's the other big thing. Mike Schuster, the late Mike Schuster, in his studies, and we know that he was the well-known employment guru in South Africa, and he calculated that the country has lost more than 1 million jobs in those 10 years, from 2011 to 2021. Right, because the economic growth rate never reached an average of higher than 1.2% over those years. Now, MoneyWeb also reports that the power outage in South Africa are expected to lead an abolition of about 350,000 job opportunities in 2022. And it may go as high as predictions that I saw to, again, more than 500,000 in 2023. So the unemployment rate is likely to increase quite tremendously, as we know in the retail sector, restaurants, tourism activities, clothing activities, even the motor car industry this morning said that their exports have dwindled, and that the selling of new motor cars are starting to feel the pinch of load shedding. And they also is about to lay off a lot of workers. Now, so this effect may be a big danger. Then, of course, the impact on the rand. We know that the rand is its lowest level in 2023. I saw yesterday again on its way to 17 rand and 50. So it is at its lowest level since the beginning of stage 6. As we look at those graphs there, that the rand depreciated in a time when the DXY dollar index have increased, which should have appreciated the rand. Right, so it should have appreciated the rand. So it was since the end of about October, when load shedding 6 started to come in, that the rand depreciated. Now, what's the implications? Now, we will hear from Hugo afterwards on what do they think is going to happen with the financial markets. But it's quite clear that South African companies, South Africa Inc. companies, will have a pressure on their financials. We look at financial retail, some of the other shares. However, and this is an interesting situation. And maybe it was a sleeping giant that we didn't realize, that the top 40 shares, as well as the all share, over the last 6 months, in fact, have improved by about 18-19% since the beginning of the year. The all share went from just over 75,000, broke easy through 76, 77, 78, and now above 80,000. And it seems that that shares don't bother about what's happening on load shedding in South Africa. And the reason why is that the top 40 shares we know generate a large amount of their revenue offshore. So it's the global environment which will influence them. They are rather linked to US rates, inflation, and China and the reopening. And it seems though that prospects are good going that way. So that is just if we look at what may happen with some of our share companies. So thank you very much. I think this is an overlay of what we think is a very sad story on how it may affect, or definitely are going to affect, the South African economy going forward. Thank you, JB. Thank you, Stian.
Thank you,
Dr. Chris. Just from my side, just one question I have before we get Nico, and I don't see there are a lot of questions. I think people are still processing everything you said. If we had to go and say, what would you say is, and what I hear you say, I just want to clarify, is the silver lining around the dark clouds looming in the horizon is basically the fact that a lot of South African top 40 companies are invested and generating revenue offshore and then reporting in South Africa and basically profiting from offshore profits and dollar-based income streams. Is that correct?
100%. We've done the calculations before. I think 70% of the top 40 countries earns more than 60% of the earnings not in South Africa, but offshore.
Sure. That's incredible stat.
Yeah,
And then
well,
last
that
thing,
is.
and I know,
So one could expect then as US share prices started to improve, the prospects for the world economy to improve, the oil price coming down from about $120 6 months ago to the current about $85, inflation expectations lower, we're nearing the end of the business cycle, the Chinese economy improving after their COVID problems that they have. It's no wonder then that the South African all share index did what it have done up to about yesterday. I see this morning again far above the 85.
Yeah, sure. And then the last question, which is a completely left field question. And we get this a lot. So out of an economist perspective, should the average man on the street invest in solar?
Yeah, you should, if you can. Not only investing in solar, just make sure that you have solar at your home as quickly as possible. Because it seems though that Eskom is not going to be solved in the next 2 years. But Tasha saying 6 months. It's possible. If in this budget the Minister of Finance privatize the coal-driven stations, he private sell it. If he does that, and then privatize it and privatize other generation capacities into the grid, we may solve the problem in a few years. Okay, but then you must be willing to, of course, at least see about 25,000 people losing their jobs in a very quick time. So politically, it's not a viable option. So we could have done it, or we can do it by privatizing it. Well, look what happened when we privatized not the South African Airways, but the air routes domestically. The moment we privatized that, price of flying tickets to Cape Town for about 10 to 15 years even got cheaper. So when we privatized the routes, not the South African Airways. So investing in solar, I think, is a very, very good probability.
Okay. If I maybe add to that, yeah, and just lastly on solar, just keep in mind that there is a bit of a tax advantage for clients that do that through a legal entity, that you can write down the full investment in your solar as is tax deductible. The full amount is tax deductible in the same year.
Yeah. I think just two things that someone once told me. They said not all the suppliers in the alternative energy space are thieves, but all the thieves are in the alternative energy space environment. So I think it's important that if you put down, I see some of my clients are on the call that are very reputable solar suppliers. But I think it's really important, just out of investor perspective. I know of people that's been shocked through the whole process. So I think it's really important when you do that, make sure you get a good, reputable guy. Rather pay 1 or 2 rand extra and make sure that you get a proper system than going penny-wise, pound-foolish. Cool. Thanks, Dr. Chris Adams. I really appreciate it. I see there's no questions coming up, but you're welcome to post some questions. And then Hiku, on your side, Hiku Fourie, thanks for joining us and hosting and gracing us with your presence. If you just on Hiku's side, where, as JB said, he's just going to talk a little bit about more on the market, and this I think can be very interactive. So if the attendees have any questions, you're more than welcome to throw them up, and then we can have a look at that. And then one question from Jacob. Will we be able to get the presentation slides? Absolutely. And also the recording will be available afterwards as well. So if you guys or the members want to use the recordings, you can download it from the webinar links as well. Over to you, Igu.
Yes, good day. I just want to get the presentation going. Can everybody see my presentation, Stian?
Yes, you could.
Yes, yes, we can see it.
Yes, thank you.
Okay. Thanks for that, Dr. Armsa and JB. I think it's all very relevant that we're talking about. And before we get too bleak about South Africa and investing opportunities, hopefully I will show you some stats and portfolios that can really do well, even in the midst of really dark days for South Africa. Please stop me anytime, in between, ask questions. I'm used to interfacing with clients, and answering their questions. So I don't want this to be a one-sided show. So if there's anything and you don't understand anything about a portfolio, just raise your hand and ask a question, and then we can address it as we go. I'm just going to raise a couple of important points when looking at portfolios, especially from SPW and how we do it. I think it's important. Afterwards, if you want a little bit more detail about how we do stuff, you can contact me either via JB or Stian. I've got my contact details, and then we can sit down and show you, in depth, what do we do and how do we do it, and what makes sense for each particular client. But in general, I think the one thing that a lot of clients, especially the last couple of years, forget, investing is a long-term event. It's not something that we do on a monthly basis or a quarterly basis. It's a thing of 3, 5, 10 years. I think a lot of the times the clients get anxious because they look at their statement on a monthly basis and the markets has moved, and they get worried, and then they tend to make the wrong call. A classic example would be Naspers process last year. Big trading process at 700 Rand, and it's trading now 1,400 Rand. Now, when it was trading 700 Rand, we had so many clients phoning us, why are you holding the share? Why are you doing this? And when we started to sell a little bit now at 1,400, we've got the same clients, why are you selling? Why are you selling? And that is the emotional response of the clients. It's something that should not be. That's something that just makes investing difficult for yourself. And so I think whenever we speak to clients, whenever clients or advisors look at portfolios, you have to look at it on a long-term basis. To look at it on a short-term basis, and it's just confusing what you're trying to do. So when we look at a long-term basis, what we're trying to do is you're trying to always buy value. There's different ways of doing it. You've got momentum, you've got growth, you've got distress. There's many strategies that you can use to invest. At SPW, we always try, when we buy something, we understand that there's value for the client. We're not always sure when the value will be realized. It could take a year, it could take 6 months, it could take 3 years. But we know when we do our deep dive and we do our analysis that there's value that what we buy, either on a cash flow basis, like a British American Tobacco that gives you a 9% dividend yield, or something that gives you a little bit more growth, with a smaller dividend. It just depends what we're trying to do, but we're always trying to, when we buy something for a client, it must make sense on a value basis. And that is, sometimes it takes time for clients' portfolio to be implemented. For instance, if a client gives you money today, like you heard from Dr. Armsa, that the market has moved considerably over the last 3 to 4 months, I'll probably only invest about 40% of the cash, because that's the opportunities that's currently present. But again, it takes time to implement the money. It takes time to buy the right quality stocks at the right price. And I think that is how you get real gains, by doing the daily tasks very well. Investing is not a quick race. It's a longer term race. It's a slow race. But if you do the right things on a daily basis, well, you'll get the real gains. And I think we must also understand people save over decades. So people are not going to give you money beginning of the year and they want you to save to double it in a year's time. I think if you do a nice compounding of 8 to 12% compound over time, that's what we're trying to do. That's how you make real money, and that's how you see people really getting wealthy out of the stock market. Just another thing, we always try and look for long-term winners. If you look at something like a Richmond over the last 20 years, it's done incredibly well through all those crises that Dr. Armsa has called upon. It's an Asian crisis, the tech crisis, or whatever crisis it might be. Richmond was just doing well, and it's really done well the last 5 years as well. Something like Naspers. I remember when I got into the market, Naspers was trading at 100 Rand. It's trading at 3.5, well, trading over 5,000 Rand combined with Process. Something like Capitec, Standard Bank, FirstRand. All those are examples of having great companies over a long time producing really compounding returns. And again, if you buy those at the right time, it's going to give you great results. And just, our performance has been in the top quintile over the last, how many years, just showing that this method in our madness, and what I'm going to show you now, we're doing well. We're not the only strategy. We're not the only guys that's doing well. It's just the way we do stuff. There's other people that's doing better than us with better strategies, and I think you need to understand that one size doesn't fit all, and that's fine. That's just the way that we do stuff, and just it's important to have a process. So if you haven't got a process, your process is not always going to work, but over time it will work. And I think that is important, to understand your process and what you're trying to do. So just our returns quickly, just to show you, and then we'll go into the portfolio. 12 months, we've done about 7.6%. And I think the important part is that after fees, we always try and beat the JSE All Share Index. And that is what we're trying to do with our portfolio by selling expensive shares and buying quality, less expensive shares. So over time, you can see that really worked for us well, especially the last 2 years when it was really dark days. So yeah, the last year to 2 years has really done well for our portfolios. And just a graph in terms of showing what we've done compared to the JSE All Share. So over time, I think you can see that the process that we do follow is working. Yeah, and we're doing the right things. So just on our equity holdings by sector, what have we done? And you can see, talking back to Dr. Holmes about the earnings of the companies. Most of these companies that we see here is produced offshore. So we've got big holdings in gold, we've got Sasol Platinum, non-precious metals like Anglos and so forth. And the other holdings is Richmond Tobacco, is BTI, Richmond Tobacco, and Naspers and Process. And all those companies you can see is earning offshore. So even by investing in South Africa, you get great offshore exposure. So you don't need to go offshore to invest offshore. Going offshore, investing offshore, it's a lot more expensive. It's difficult because it's a lot bigger playing field. Sometimes you understand less of the companies, but I think if you just stay in South Africa, we've got great companies here that's earning great offshore dollars, and you'll see that comes through in the JSE's performance. So just breaking down our sectors here, you can see our top holding is Naspers Process. We've got a big stake in Richmond, Anglo, BTI. So if you look at all these top companies, most of these top companies is earning offshore revenue. You've got Spar's also got a offshore entity, Mondi, Investec, FirstRand, Bidcorp. I just had excellent results yesterday. I think the last year Bidcorp has done about 30 to 35%. Again, it's not a big counter. Everyone doesn't know about it. Great business in the UK. And by buying Bidcorp at 250, 260, it's trading at 380 now. You've really made some good money for your clients. So yeah, you can see our portfolio is very diversified. We make sure that everything that we've got in the portfolio is really looked in terms of value and where we buy it. And when I get new money now, for instance, I need to implement this portfolio, I would go through the list and see where is there still value available. So something where I do think there's value is something like in Netcare. There's value there. I think maybe Bidvest, I would buy some of these levels. So when we implement the client's portfolio, I won't just go and buy everything in the sector. I would really go down and make sure when we execute for a client, we execute the right prices. Because if you don't buy at the right prices, you can buy a great company at the wrong price and not make a return. So if you bought Microsoft in 2001, and you've kept it for 15 years, you were down on your money about 50%. But if you bought Microsoft in 2015, you've made over 500% in your money. So it's very important to buy things at the right time, even great companies. And I think that's one of the things Warren Buffett has done very well, is buy great companies at a great price. Then you really enhance your return. So please, guys, if there's any questions or any, just pop me a question. So just some of our thoughts on the world currently. So the world is really uncertain. We don't know what's going to happen. You know, especially South Africa, is it going to collapse? The ANC, you know, it's really uncertain, and it's very hard to try and predict. You know, you've got the Ukraine-Russian war, you've got American elections coming up, 2024. But what we try to do, we try to build a portfolio that will weather the storm. You know, so it doesn't matter what the outcome is, we will get through it in some time, and that is again back to buying great companies, quality companies, great management, you know, and at the right price. So it all comes down to the process. You know, it's very hard to understand what's going to happen in the world. It's a lot easier to understand asset prices and the value you buy something at. You know, that I think that is a process that really drives gains. Like I said, we're very conscious about valuation. And prices are very important for us. I think one thing that has changed over the time, the last 6 months or a year, is before 2022, there was only one place you can put your money, and that was in equities. You know, bonds, like JB said, was giving you, I think, 1.5% in the US. Germany, it was -50 to -80 pips a year. You know, so you couldn't really buy bonds because you don't get anything for them. You know, currently, bonds has re-rated in America to about 3.5%. Currently, it was over 4%. So suddenly, you've got alternative assets that you can use to build your portfolio with. If you had bonds beginning of the year, and as SPW didn't, because we couldn't see the rationale for having bonds giving you 1.5% in your portfolio, you know, you lost about 20% on that. And it brings alternatives in play. You know, one of the things that we do have on our platform is Greenpoint Credit. It's a credit fund that just gives credit to mid-sized companies in South Africa because the banks don't play in that space anymore. Greenpoint has given us this last year 15.7%. You know, so that's just an enhancement to your equity returns. You don't put all your money into this, but if you put 3 to 4% of your money into a Greenpoint product, it really is a nice enhancement to your portfolio, and just move your portfolio's risk-return adjustment to the right. Then as well, it's very good to have a balance between local and offshore. So last year we were more favouring of local, and I'll show you why we thought local would be a better suit in the portfolios, and we reduced the offshore exposure. This year it's more neutral. I mean, the developed world has come down quite a bit. It makes a lot more sense. For instance, you could have bought Facebook or Meta, as it's now currently known, at almost a 7 PE. Last night, it's given earnings is up 20% pre-market. So what I'm saying is, it's definitely in the last year opened up more opportunities in the offshore space than it used to be. Something like a Berkshire Hathaway was also trading at about a 7 PE, trading about 270. It's now about 310. But what I'm getting to at is there's more opportunities opened up in the offshore space. South Africa has really done well in the last year, and like I've showed you before, the opportunity is a little bit less currently. You know, Naspers process has done really well, Anglo has done well, you know, Richmond has done well. So it's all about valuation and where the opportunity is. I think Dr. Harmse has talked about this, and I think JB as well. You know, so asset class performance, if you look at the globe and where did you make money last year, you know, you've made in South Africa 11.4%, and this is all in ZAR. USD cash, you've made 12.6%, but that's just the devaluation of the rand. Global property, global equity, global bonds, you've made no money in ZAR terms. You know, so having been in South Africa last year with the blackouts, with the ANC government, you still made better money than anywhere else in the world. Over the last 3 years, you know, pre-COVID, you know, if you look at SA equity, you've done 14.8%. Global equity, the S&P with the ZAR has done 11.7%. So I think we tend to get too bleak in South Africa. There's always great opportunities in South Africa. You know, Shoprite in 2019, 2020 traded at 100 Rand. There came a new CEO, new focus. You've made over 100% in your money in a SA Inc. type of business. So I think we as South Africans living here, experiencing the blackout, speaking to our friends, we tend to get too bogged down and too, what's our word, right? Uneligted type of scenario that, but South Africa is always giving us good returns. And if you get a manager that follows a process and buys the right equities or the right assets at the right price, you're always going to make money in ZAR. And I think that's important to realize, that forget about the ZAR and all that stuff. If you buy the right assets, you're going to make money. Speaking about the ZAR, and Dr. Chris Harrison will probably point to this, the ZAR is extremely weak and we know it, but if you look at the purchasing price parity, it should be it should be closer to about 14. You know, so it's also important when you take your money offshore to do it at the right times. You don't want to take money off at 18 and then the Rand strengthens to 14, because that's just going to erode your gains again. So that's why it's a lot of times easier just to keep your money in South Africa, invest in companies that makes earnings offshore than taking money offshore at the wrong time and then trying to make money on the back of that. That's a lot of times difficult. Most of the times you get it wrong. Just when you think the Rand should weaken, it strengthens, and vice versa. And this is just a guide to show you where it should be doing and what it should be doing, you know. But it's obviously, like Dr. Ramsey said, it's the Rand is very weak at the moment, and it's probably going to get weaker. But investing locally, you can actually get the gains of the weaker Rand over time. So why did we, a couple of years ago of last year, favor South Africa? So if you look at just the relative earnings of the JSE, and you've got an exit P of say 12 times. So if you say the consensus earnings this year is going to fall by 10% on the left-hand column, and you get an exit P of 12%, you're still going to make on these levels a 6% return on your money in the JSE. You know, if you say you're going to have an XP of 14 and you get consensus earnings, then you're going to get the 16% return on the JSE. You know, and that looks still reasonable for us, you know, to invest in these levels. And if you look at why is that, you know, if you look at the forward Ps of a selection of SA equities on there versus a 10-year average, you can see South Africa is very cheap. Look at something like an Aspen. It's got great offshore earning potential. And it's trading a 43% discount to its 10-year average forward P. Something like Sasol is trading at a 3P currently, you know, with chaos in the oil and market offshore. Something like Sanlam, British American Tobacco, you know, so there's still a lot of value in South Africa based on a 10-year average. And that just ties back to the previous one, where you buy something and the earnings they produce will give you the return. So if you look at the S&P and why we think it's still expensive and why we don't really want to go there, there is pockets of value if you're brave. But if you just go and buy the S&P 500 as an index, if you take consensus earnings say of 16, which is more the average in the middle, and you say, well, earnings is going to fall 10% with the rate hikes, you only can make a 2% return. You know, I mean, you can buy the 10-year bond at 3.5%, you know, and that's a lot less risk than investing in the S&P. So even though it looks bleak in South Africa, the price that you buy South Africa more than compensates you for the risk you take. And that's what we're trying to show you here. You know, the S&P is still very expensive on the global terms, and therefore returns going forward is probably going to be less. You know, we probably need the S&P to go lower and give us better opportunity before we really start buying it aggressively. I just want to show some other indicators that we do look at. So if you look at the valuation in the top left-hand corner of the USA, if you look at price to sales, which is the third one. So the price to sales is 2 times 3. It's 90 in the top 92% percentile of all time of how expensive that is. Now, if you take the same metric, price to sales, and you look at South Africa, it's 1.5. And if you look at China, it's 1.1. You know, that's a lot less cheap than paying 2 times, 3 times sales for something in America. And you can look at the forward P of 17 versus 10.6 in South Africa, and way to the right, 11.5 in China. You know, so that's why we still favor more South Africa and developing markets than putting money in America, which is expensive. Potential outcomes, and I think Dr. Harms will probably speak more to you about this, but you know, our view is there's probably going to be a hard landing. Personally, I think we're probably going to be more of a soft landing. I just think there's maybe people's got a bit more flexibility in their spending and the way they spend their money. But we'll see. You know, we had the Fed meeting last night. They're probably going to raise another 25 for the next 2 meetings and then pause. But they're still out for debate what we're going to get there. So yeah, I'm not sure. Dr. Harms probably got more info on that. 23 outlook China. You know, China is out of sync with the rest of the world in terms of where they are in the economic cycle. They've got a lot less inflation. They're probably going to stimulate the economy more, whereas the US and developed world is more tightening and increasing interest rates. So we've got a China exposure via NASPA's process. And that's how we play that there. You also don't want to be too exposed to China with the regime and the way they do stuff. Yeah, just trying to do that. And then obviously the retreat from zero COVID policies, you can see it opened up a lot of trade and the economy. Just in the China inflation figure, so China is on the is the blue graph and US inflation is right graph, and you can see just relative how low China is versus the world. I think China is currently sitting at about 2%, and America is sitting at about 6%. So there's this dichotomy in terms of they can still ease China and really get money into the economy, where America is taking money off the table. Just some of the opportunities we did see in China with Tencent was extremely low, trading just about 10, and that's why the big rally we had in NASPA's process over the last year. And again, you know, if you bought a great company at the wrong price, which was the average, say, in 2021, you know, you're still losing money. So it's so important to buy good quality assets at the right price. That is at the end of the day what we're trying to do for the clients, and really get that entry points right and make sure that the clients makes money out of these great companies. Just some of the movements you've seen out of NASDAQ's process over the last couple of days. It's really of the last 3 months in September, December. You know, it's really, I mean, NASDAQ process is up 30%. NASPA's is also up about 40%, you know, and that's great. I mean, that really kicked the portfolios. It's really done well for the clients. We are taking a bit of money off the table here, and it's just based on the discount with Tencent. NASPA's process is trading at the smallest discount for a very long time. So we're feeling that we're taking a little bit of money off the table, and we'll take that money and we'll deploy it into something else where we see opportunity. Where there's some nice upside in the equities, and that's how we create value for the customers. Where we sell something that's relatively expensive. We don't sell the complete holding. We'll trim the overweight. We'll trim it a little bit down, and we'll take that float, that money, and we'll buy a different counter, something like a SPAR or a Netcare or something else that makes sense to our valuation team, and hopefully by doing that we'll create that outperformance over the JSE.
Sorry, we're running out of time.
Yeah,
so,
I'm almost finished.
Okay. There's one or two questions I want to just pose you before we close on.
100%. Yeah, so I think just lastly, at SPW, we really build customized portfolios. No one portfolio will look the same. There will be marked similarities between all the portfolios, but it depends on the timing and when the client enters the market with us. That will really dictate. But over time, yes, it should look the same. But we're here to really give clients a personal experience in the market.
Cool. Thanks, Jay. Hugo, just two questions from my side that I quickly want to pose to you. The first one is, if you want to go into a personal share portfolio and have shares in the portfolio, how much money should you look at before looking at something like that?
To have a really nice diversified portfolio, you probably, you know, the quick answer will be R1 million. But I think from about 300,000 on, you can start looking and having a diversified portfolio. You know, I think if it's less than that, the transaction cost becomes a bit expensive and your holdings becomes too small. But I think a younger person from 300,000 up, if you're a little bit older, maybe a little bit more, 500 to 1 million, you know. But I think at the million is a sweet spot, then it really works well. You can build a nice diversified portfolio. You can have a 30 or 20% stake offshore as well. But yeah, I think it also depends on what else the client has and how the complete portfolio will look like.
Okay. And then just the last one, and it's more of a rhetoric question. Correct me if I'm wrong, the platforms, so a person they don't have to go to you directly. They can, through NMG, invest through their retirement annuities and some of their personal investments that they have with Momentum or Sanlam or 91 or Alan Gray. They can have a share portfolio through those admin platforms or list platforms to SPW as well. Is that correct?
That's correct. So yeah, we on the major, platforms: Momentum, Glacier, PPS, ABSA. I think use the other platforms. I don't think we can do Alan Gray or 91, but most of the big ones, you can on the platforms you can subscribe or allocate to a SPW or Sanlam Private Wealth share portfolio. So you can allocate in a certain amount, say of the R1 million. You can allocate 30 or 40% to a personalized share portfolio, and that portfolio can just be a pure equity play, or it can be it can either be an offshore play as well. But you can have different mandates on that.
Okay, cool. Yeah. Anything else? I've seen no questions coming through. Anything else, JB, from you, Dr. Armser?
No, nothing from our side, Stian. I think maybe closing what I did pick up from you, quite similarity with what Dr. Armser mentioned, that we do have the China reopening play, and people just keep in mind that there's a spillover effect onto our markets. And that's irrespective of this through process and NASDAQ. I mean, commodity China reopening implies commodity prices, a demand for commodities, which can filter through, and that also adds to the fiscus. The tax authority can also benefit by our commodity producing companies generating more tax revenue, which is going to spill over effect for our indirect economy as well.
Okay. So all in all, recapping what I hear from the panel is, first of all, yes, we need to invest in solar for ourselves, but economy-wise, we might go into a bit of a challenge. But when it comes to investments, investing in the correct places, you will still be able to earn a good return on your portfolios if you invest properly.
Yes, there's only one golden rule, eh? Always get in the market as quick as you can and stay there.
Yeah,
absolutely. So from the panel side and everyone else, NMG, everyone that's assisted in this webinar, as I said, we will be hosting this on a quarterly basis. So in the next few weeks, we'll send out the next reminder for the next quarter. So thank you, everyone, all the panelists and everyone attending. Have an awesome day and enjoy the rest of your week. And good luck with February.